Hey everyone, hopefully you're having a good day. My name's Andy. My channel's Finding Value. And what I'm going to talk about now or today is a Twitter post where this guy is writing something that I just think is just wrong. But we're going to talk about inflation. That's really what it's going to be about and what my opinions are about it. But this is what he says. All right. Let me zoom in. And if you guys want to follow me, it's at finding_finance. It says, say it with me. To control inflation, we must take aim at corporate profits, not working people. And I'm just going to say this is the stupidest thing I've ever heard in my life. Complete, full. You've heard the if you've seen the movie Tropic Thunder, never go full retard. This guy's going full retard. I don't care how many followers he has. This is not where inflation comes from. And I hate to say it, but if you tax corporate profits more, what's going to happen is corporations, they don't pay taxes. The end user does. They just pass along all of those taxes to the working people who buy whatever the people buy from those corporations. The best thing you can do is put corporate taxes to zero. Maybe make a sales tax if need be, and try to get as many corporations to open up in your country as possible to create as many jobs as possible, if that's what you want to do. But taxing corporations is nothing more than just taxing yourself if you buy products from those corporations. It's not like if they tax it more, they're just going to raise the price that increase. You could say that taxing is inflation to some extent. Because whatever you tax, you get less of, which then means you get higher prices. So this guy, I don't know. He obviously, I don't know where he went to school. I don't know anything about him. He probably wrote a book, but I do not agree with this at all. Now let's talk about inflation and what my opinions of inflation are. Mark said, please give this guy an education on M2, Andy. Now it's just deeper. It's deeper than M2. So I'm going to go into what inflation is and why I think the setup going into the future could be extremely inflationary. So M2 money supply, this is your M2 money stock that I have on TradingView. And one thing you want to notice is this thing, if you were to draw kind of a trend line, if we were just kind of like average this out, you get a trend line that goes there, a trend line that goes there, a trend line that goes there, and then you get another trend line that's going vertical. And you can see that the rate of change of M2 money supply growth or M2 money stock is going vertical. You can also see that we have some M2 money coming out of the system up here. We've got a little, movement lower. So M2, the way that we've always had this in the past, and again, I'm not saying that this time is going to be any different. I'm just saying historically, what happens is the M2 money supply grows at a faster rate than what your energy and commodities can grow. So inflation is nothing more than the ratio of M2 money supply divided by GDP. GDP is more or less your ability to put product through a system. That's your total transaction volume put through a system. So if you were to do a ratio and you were to look at the M2 money supply in relationship to GDP, that would be your money velocity, and that would also be, we'll call it the efficiency, or I should say that you'd call it almost like your inflation in the system to some extent. So inflation's the byproduct of how much M2 money supply is divided by your GDP. And they call that velocity. So if we were to look at money velocity, if I were to yank up money velocity, and what we're going to see here is a large, steep decline in money velocity all the way down here. And now we're getting the money velocity kicking up. Now, I said this before, like in here, I said, hey, look, your money velocity is starting to kick up. And everybody's like, ooh, so what? It's gone nowhere. I'm like, well, keep watching it. I mean, everyone is so short-sighted. It's kind of annoying. I'll say that to some degree, man. People are that you have to look at these trends and see how they're going to move, because this could break to the upside, which means your money velocity is moving up. Now, it's not just money velocity. This chart, I don't think, signals the depth or complexity of the markets. So when people look at this, they say, "Oh, it's look at this money velocity. Inflation's going down." It's like, no, not necessarily. Money, they printed a bunch of money. It went into the banking system, and it didn't get into the hands of people. So of course your money velocity went down because they jammed it and stuffed it all in the financial assets. How do I know it went in the financial assets? Well, look at the ratios over time. The stock to commodity ratio was at all-time lows, meaning that the S&P 500 had so much money jammed in it because of interest rates and the market condition and all this money printing that went into banks. They jammed it all in stocks, creating the largest opportunity of anything that I've ever seen in my life, because everyone got all on one side of it. They got all into the S&P 500. Now, let's get back and talk about what inflation is and how this all works from, I'll say it, the most layman perspective that I can put it in, so everyone can understand it. Stocks, the S&P 500, is nothing more than a conversion of commodities using energy into usable products. I'll say that one more time. Regular stocks, most of these companies, are nothing more than converting commodities plus energy into usable products. Now, here is the problem. The M2 money supply, so we're going to do the M2 money supply divided by gross domestic product. I think I have this down here. Let me go real quick and find it. So the M2 money supply divided by gross domestic product, which is more or less your money velocity, inverted. It's inverted money velocity. And what this is showing us is that they were creating more money than GDP back in this entire region here. That's why we were in such a large uptrend. They were printing money at a faster pace than GDP and throwing it in financial stocks and bonds. Then they blew up this gigantic bubble in stocks and bonds. Now that money, this money that's in the system here, is only seen in the consumer price index if either that money goes and tries to buy usable products, or we have a problem on the commodity side or energy side. So when you look at inflation and the way that they measure it by the consumer price index. The 1970s had a couple of things going for it, which had very high inflation rates. It had a demographic coming into home buying years, and one of the components in the consumer price index is higher home prices and rent prices. I think it's called like homeowners equivalent price or rent or whatever it is. Then they've got the energy sector, they've got food sector, they've got all those things, which is more or less just energy. Food prices go up when energy prices go up. Fertilizer goes up when energy prices go up. Everything goes up when energy prices go up. And they had a 1970s, in 1970, we had peak oil. So USA, peak oil, we had a constraint in our energy delivery system. And we hit peak oil in 1970. We hit that constraint. We were coming back down, and we had all these baby boomers coming into home buying years, which had more liquidity into the system and less energy to back it, which was a highly inflationary environment. Now, when you have all of these, I'll pop in here real quick. When you have all these commodities out in the world, they're everywhere, right? We had a surplus of commodities and a surplus of energy for a very long period of time worldwide. So your factor in the equation of inflation is money supply. And it's only money supply if you can grow your commodities and you can grow your energy sources. because that's just it's just a little bit of a lag behind it. Now, what's coming up, and so that's what inflation was prior to what I think is coming. It was money being created at a faster rate than you can grow GDP, and then the supply would catch up, and you'd get this balance. It's a ratio between the M2 money supply and GDP, just like I have behind me. So in this time frame back in here, all this is a balance between if this goes down, your GDP is growing faster than your M2 money supply, and then your money supply grew a little bit faster than your GDP. That's your inflation coming into the system. You could literally have this as inflation to some degree. Now, what's happening is they created all this money. It's rotating around. It's starting to find itself into the commodity sector. Now, when commodities go up, inflation goes up. Like, that is it. And your housing market. Your housing market can come down, but all of the other factors in inflation will stay elevated because you've got money in the system that is now going after and trying to find a new investment home. And they send all these checks out. There's all this stimulus and all that stuff. So in my opinion, what we're coming into is not just an M2 money supply growth in relationship to GDP. I think the GDP is going to be constrained because we have constraints in commodities and constraints in energy. And if the system must grow in order to service the debt and the obligations in the system, that is where your inflation of the M2 money supply will come from. The inflation in your consumer price index will go up because your GDP will be constrained through energy prices and through commodities. That's why when inflation was really high, they released the Strategic Petroleum Reserve to cap, one, to cap the inflation, and two, to cap the profits that Russia could have. I think it was a combination of multiple things. Because Russia would earn a lot more money if oil was, $100-something a barrel, 150, 160, whatever it would be. So they used that to tamper this all down and control it, in my opinion. But what's coming is if you can't grow your GDP and your M2 money supply must grow in order for the credit in the system to remain solvent, that's a problem. Because then you're going to have an M2 money supply that will eventually move higher. And your GDP won't go up. Which means that your M2 money supply will do exactly what it's doing. It's going to break out and keep going, but this time the GDP will be constrained and they'll keep pumping money into the system if they want it to remain solvent. And that's where the problem is. That's where massive inflation is going to come. And if you look at it, if you think at things, a little bit deeper, right? We look at all these deficits out in the future: copper deficit, nickel deficit, cobalt, graphite, lithium, zinc, tin, and other energy deficits that we're going to see. All of those deficits are going to push the prices of these metals higher. It doesn't necessarily mean that all of the companies will make more money because their input costs are going to go up as energy goes up. So as these prices go up of metals, you know what's going to happen? Prices will go up and they're going to say, let's go drill some more, or let's go mine some more. And they're going to go mine more, but what do they need in order to mine? Some of these are 50% of the costs are energy. They need a lot of energy. With declining ore grades and an exponential increase in energy consumption given the declining ore grades, and all the new ore grades coming on need more and more energy. So when those prices skyrocket, they say, hey, let's go drill, let's go mine, let's go do this. And it's at declining ore grades with more energy input. All of the demand for copper, all of the demand for nickel, all of the demand for any mineral that is sitting under the ground that we have to mine out is future energy demand. I'm going to say that again because it's so important to understand this. So as the M2 money supply increases at a vertical pace that I showed you just here recently with the M2 money supply, let's go through it real quick again. Your M2 money supply M2SL. There we go. Your M2 money supply on a big picture view, your rate of change is not much. Your rate of change steepens, and your rate of change steepens, and your rate of change steepens, and now you're going vertical. And if you have a constraint in the system where your M2 money supply goes vertical and your GDP can't match this going vertical, you're going to have massive inflation. So that's when we go back to the M2 versus the GDP, and we've already broken out in the year 2010 to the upside, and we're moving higher. And I know we've pulled back a little bit. They've been sucking M2 money. They've been sucking money out of financial assets, but this is going to break higher, I think, because the system, in order to survive, this is going to outpace your GDP, which is going to be massively inflationary. And what I'm saying is your GDP is constrained through commodities. We all have seen the deficits out there in copper, nickel, and all these different things. If those are deficits, and we're already running into energy constraints at this time, and I were to look at, say, I'll just pull some up. Here's the copper deficit, right? We'll pull this up, and you can look at any of these guys talking about it. But what happens is you get these deficits out here, 10 million ton deficit out by 2030. That's going to go into a deficit. And as we replace the production of some of these copper mines, they're going to be lower and lower ore grades. There's that deficit right there, the orange. So when we go through here and we start looking at all this stuff, guys, and we see future energy demand kicking up kind of at an exponential pace because of the deficits in all these different minerals, the declining ore grades, all that stuff. I don't know how they're going to stop the inflationary move here. And what transfers all that inflation into the consumer price index is oil. Oil is your number one commodity. If oil is your number one commodity, it's going to transfer all that stuff right to inflation in the consumer price index. That's how they're going to be seeing it. Now, if your inflation goes into financial assets, no one cares. They can still live, they can still eat, they can still do all that. If you see constraints in our energy supply, and we try to ramp all the minerals for mining, that is future energy demand for diesel, for oil, for natural gas, for all these different fossil fuels. The difference between the M2 money supply and GDP, if we have a constraint in GDP, it's going to look like the 1970s. The money supply coming in is going to go up, and it may not even go up because of the housing market. The housing market was the pacing factor historically, because we had very little people going, a very small population going into retirement in relationship to the demographic that was younger. And if the younger demographic, the baby boomers, go into retirement age, the obligations that the government has to pay those people through Social Security, Medicare, Medicaid, all these different programs that they have, will be inflationary because that money's coming into the system continually. And the base to support that is much smaller. So they're probably trying to get immigrants and all these other people in here to basically take this top-heavy retirement demographic and try to get more people in the working population. And you can see that the working class down at the way bottom, there's a smaller demographic down there. And that's why we have shortages of all these different job openings. So I think we're going to get hit on every front. We're going to get hit on higher wages. We're going to get hit on a demographic that's getting paid out in ever greater quantities and running deficits. We're going to have higher interest rates and higher interest rate payments. And that's your money continually flowing into the system. We also have millennials coming into home buying years that want to buy homes. But it depends on how much money comes into the system. It depends on what your GDP can grow at. And it really depends on commodities, we'll say the supply-demand balance of commodities and energy. That's what will transfer it into the consumer price index number. That's what's going to drive your inflation interest rate going higher. And as your interest rates go higher, it's going to rotate even more money into precious metals, into commodities, and energy and all those different things. That is how I view it. And that's what I think is going to happen. We've had massive underinvestment in commodities. Now, I don't know if that investment would necessarily fix the problem. As these big major mines start to deplete, I don't know if new mines can offset it, no matter how much money you throw at this thing. Now, that is obviously a debatable topic, but at some point, that will be a fact. And I don't know if we've hit that point yet. Maybe it's 10, 20 years out. Maybe it's not. I don't know. But at some point, money won't fix it because you're running into physics, physical constraints and physics and the how much earth you can move given a certain ore grade, how fast you can move it, how fast you can process it, and how much energy we have to do this. And what are we going to do? Recycle through the earth's crust? Just recycle it all and try to get every mineral we can out of it? I don't know. I mean, from an environmental standpoint, that might be kind of nasty looking. But prices of things could go up dramatically. We're going to strain the resources in the earth, and I think that will end in an inflationary movement. I don't think it'll be deflationary, but and they're going to continue to print money to keep the system alive. That's what they've done in the past in almost every instance. So that's what I've got for today, guys. That's inflation. That's my look at it or take on it. If you guys like the content, give me a thumbs up. If you guys need help in this commodity bull market that's coming, due to everything that I've said in this post, platinum membership, finding-value.com. And that's all I've got for today. We'll catch you next time. This is Finding Value.